Alright, now we're ready for 9. And this one's a little bit different. This one's kind of, well, let me show you how you work these kind. As you look at 9, they purchased a computer for $3,100, debiting computer equipment. So this is the old, alright? So that becomes $3,100. And the next thing is, during 2010 and 11, they recorded a total depreciation of $2,200. So that has to go here. That's your total accumulated depreciation. So you've got that. And then on January 1st, 2012, they traded in the computer for a new one and paid $2,900 in cash, with no mention of how much this would possibly be worth. So how would you figure that one out? You would take the difference between this credit and this debit, and that would become the new value of the old or the new equipment, which actually comes to, well, I'll let you figure that. You'll figure that out. And let's move to 10. Are we doing 10? Yeah, it holds, it's talking about oil and gas. And we're looking at oil reserves, I think. Is it oil reserves? Yeah, petroleum. Close enough. How would they compute that? How would you compute this? It's asking you for, number 10 is asking you for, well, first of all, you have to decide what method you would use, which would be unit of each unit that you bought. And that was $84 billion, and it had 7 billion units of oil. So each unit of oil would be found by dividing 7 billion into 84 billion. That would give you, that's not right. Not back, that is right. So, and then you would multiply that times 7/10 of a billion, of a billion oil that was used. And that would give you the depreciation expense and an accumulated depletion expense. So if you look at minerals and oil and natural resources, you would use a unit of production method, and it kind of works very much like accumulated depreciation, only it's called accumulated depletion. So, do we do 11? Yes, we do. This one's talking goodwill. And again, in these cases, we kind of look at this, and I think basically, if you look at 11, it's talking about buying another business and actually paying over market for it. And that involves goodwill then. You purchase the goodwill. And you want to look at it and say, okay, how much goodwill? Well, if you read this, okay, they had total assets of $160,000 and liabilities of $80,000, and the fair market value of the assets was $120,000. Well, they could have all the reported assets they want. When you buy it, you need to record it at the fair market value here. They had liabilities of $80,000. Now, how much cash did they pay for this? They paid $240,000. Okay, this obviously does not balance, right? Because this has $320,000, this has $120,000. So your goodwill is going to be $200,000. Because these are three known numbers. So you're going to use your known And then that would be a good estimation of the goodwill. So that's question 11. Question 12 looks at, and it does look like we've do 12. 12 is talking about not recording an expense correctly. If you capitalize it instead of expensing it, if you expense it instead of capitalizing it. And what they're talking about capitalizing is depreciating it out over a longer period. When you expense something, you write off the entire amount immediately. So the question is, what happens when a tool company accidentally capitalizes the cost of the plane instead of expensing it? What does that affect? So sit down and do some figuring and see what would truly be affected by that type of mistake. And then we move on to 13. And 13 is talking about the cost of land, and you're trying to figure out what's land and what's land improvement and what's a building. Best way to do that is to make categories. I probably should have done this in columns rather than rows the way it's set up. But we can still look at this. Go through and you'll have to compare it to the book, because the book's going to give you really good guidance on what is considered land and what's considered land improvements and what's considered building. The total cost that you're looking for land, I'll give you the number and then you can figure out how it was calculated and what was included in it, so that you'll have something to understand here. And this is 13, yes? There it is. So the total for the land is $372,500. The total for land improvements is $73,000. And the total for building is $550,000. Now, go to the book and look at each of the scenarios. And the book has a really good listing that tells you what each one is. If you have questions, message me on this. This is good. Number 14, the same thing, only we're looking at having you categorize now. Remember, a capital expenditure is one that's depreciated, and an expense is one that is charged out immediately. Again, the book is a very good reference for this. We do not do 15, and that leaves us 16. And 16 is another one that is saying this is part of land and this is part of a land improvement, such as, is it a mineral asset? I think I will end this and come back and look at 16 a little more in depth, because we also have 17 to do, so that'll give us enough time. Be right back.